Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Steve Hamelin, here to provide you with insights sourced from reputable news outlets to help you stay informed and make well-informed decisions. This podcast is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their homeownership dreams. Visit realapproved.ca to learn more about how their experienced team can assist you with your mortgage needs. Let's dive into today's episode. Today, we're diving into a significant announcement from the Bank of Canada regarding its interest rates and new mortgage rules. These changes are poised to have a substantial impact on both current and prospective homeowners across the country. On January 29, 2025, the Bank of Canada reduced its policy interest rate by 25 basis points, bringing it down to 3%. This move is part of a broader strategy to make borrowing more affordable, especially in the current economic climate. Alongside this rate cut, the Canadian government has introduced several new mortgage reforms aimed at making homeownership more accessible. One of the most notable changes is the extension of mortgage amortizations from 25 to 30 years for buyers of new construction homes. This change allows buyers to reduce their monthly payments by spreading them over a longer period. For example, a homeowner with a $650,000 mortgage at a 5% interest rate will see their monthly payment decrease from $3,780.44 to $3,468.99 when moving from a 25-year to a 30-year amortization. Additionally, the government has increased the insured mortgage price cap from $1 million to $1.5 million. This adjustment reflects the current realities of the housing market, particularly in urban centers like Toronto and Vancouver. Previously, buyers needed a 20% down payment for homes priced over $1 million. Now, with the new rules, buyers can secure a home valued up to $1.5 million with a down payment of just 5% on the first $500,000 and 10% on the remaining amount up to $1 million, significantly lowering the barrier for entry into the housing market. For existing homeowners, there's also good news. New refinancing options are available for those with insured mortgages, enabling homeowners to add secondary units such as accessory dwelling units, laneway homes, or basement apartments to their properties. This change not only allows homeowners to generate additional rental income, but also helps address the housing supply shortage. To take advantage of these refinancing options, homeowners must meet specific criteria. They must own their property, occupy one of the units, and intend to construct additional units. These additional units cannot be used for short-term rentals, maintaining the focus on long-term housing solutions. These changes are part of a broader effort to address housing affordability and supply issues in Canada. The government plans to build nearly 4 million homes by 2031, and these mortgage reforms are a step towards achieving that goal. By making it easier for more Canadians to qualify for a mortgage, these reforms aim to boost new home construction and add rental units across the country. As always, it's important for homeowners and prospective buyers to stay informed about these changes and consider how they might affect their individual circumstances. The next Bank of Canada interest rate announcement is scheduled for March 12, 2025, and we'll be sure to keep you updated on any further developments. In a significant announcement from the Bank of Canada today, the Bank of Canada has cut its key interest rate by 25 basis points, bringing it down to 3%. This marks the sixth consecutive rate cut in a series of reductions that began in June 2024. The Bank of Canada is aiming to stimulate economic growth amid evolving market conditions and potential trade challenges. Understanding the rationale behind this rate cut, the latest move follows a more substantial 50 basis point reduction in December 2024. Economists had anticipated this adjustment, viewing it as a necessary measure to support the economy. TD economist James Orlando noted, "While the Bank of Canada has shifted from larger cuts to a more measured approach, today's decision reflects their commitment to maintaining economic momentum while navigating uncertainties." For many Canadians, this interest rate cut could lead to lower mortgage rates in Canada. The Bank of Canada's lending rate influences the interest rates that financial institutions charge on various products, including mortgages and loans. As a result, Canadians with variable rate mortgages might find that more of their monthly payment goes toward principal rather than interest, easing their financial burden. However, those with fixed rate mortgages might not feel the immediate impact of this adjustment, as these rates are typically tied to longer-term bond yields. The mortgage rate landscape may see shifts as lenders adjust their offerings in response to the new prime rate. The timing of this cut is particularly critical given the looming threat of tariffs from the United States under President Donald Trump. If enacted, these tariffs could significantly impact Canadian exports and overall economic stability. The Bank of Canada has indicated that it will closely monitor these developments and assess their implications for economic activity and inflation. In its official statement, the bank highlighted that while inflation remains around its target of 2%, there are concerns about core inflation metrics. The central bank forecasts gross domestic product growth will strengthen gradually in 2025, projecting an increase of 1.8% for both 2025 and 2026. Looking ahead, the next interest rate announcement from the Bank of Canada is scheduled for March 12, 2025, where further insights into monetary policy will be provided. With uncertainty looming regarding trade relations and potential tariffs, analysts speculate whether the Bank of Canada will continue its easing cycle or adopt a more cautious stance. In summary, today's interest rate announcement marks a pivotal moment for Canada's economy as it navigates potential challenges ahead. With ongoing adjustments to interest rates, Canadians will be watching closely to see how these changes affect their financial landscape in the coming months. The bank remains committed to ensuring price stability while fostering conditions conducive to growth amidst a dynamic economic environment. In a stunning turn of events, the Bank of Canada has slashed its benchmark interest rate by 25 basis points, reducing it to an all-time low of 3%. This marks the sixth consecutive rate cut since mid-2024, heralding a new chapter in the Canadian housing market and igniting hopes for countless prospective homebuyers. As the Bank of Canada continues its aggressive monetary policy, the impact on mortgage rates is profound. With this latest reduction, variable mortgage rates are expected to fall sharply, providing much-needed relief to homeowners grappling with rising costs. According to RateHub, borrowers could see their monthly payments decrease by around $87, translating to annual savings exceeding $1,000. For instance, a homeowner with a variable rate of 4.45% might watch their payment shrink to approximately $3,371 each month. While variable rates are set for a decline, fixed mortgage rates are also likely to experience some downward movement. This is largely due to recent drops in government bond yields following the Bank of Canada's announcement. However, experts advise caution. Concerns about potential inflation may temper any significant reductions in fixed rates in the near future. In tandem with the rate cuts, the Canadian government is introducing innovative reforms aimed at enhancing homeownership accessibility. Notably, the introduction of 30-year amortizations for newly constructed homes allows buyers to stretch their payments over a longer period, significantly lowering monthly costs. For example, a $650,000 mortgage at a 5% interest rate could see monthly payments drop by over $300 under this new structure. Additionally, changes to down payment requirements for homes valued between $1 million and $1.5 million are set to ease financial burdens for buyers in high-cost markets like Toronto and Vancouver. Previously requiring a hefty 20% down payment, buyers can now secure mortgages with just 5% on the first $500,000 and 10% on the remaining amount, dramatically reducing initial outlays. Despite these encouraging developments, economists urge caution as global economic uncertainties loom large. The potential for tariffs from the United States under President Donald Trump poses risks that could ripple through Canada's economy and influence future monetary policy decisions. As Canada navigates these complexities, today's announcements shine a light on a more accessible path to homeownership for many Canadians. With lower borrowing costs and supportive reforms in place, the dream of owning a home is becoming increasingly attainable, a welcome shift in an ever-evolving housing landscape. As the Bank of Canada continues to lower its lending rates, many Canadians might expect mortgage rates to follow suit. However, this is not always the case, particularly for fixed mortgage rates, which can sometimes rise even as the central bank's rates decrease. The key reason behind this seeming contradiction lies in the way fixed mortgage rates are determined. Unlike variable rates, which are closely tied to the Bank of Canada's overnight rate, fixed mortgage rates are influenced more by the bond market. When investors anticipate economic growth or inflation, they may demand higher yields on bonds, which subsequently pushes up the cost of borrowing for fixed-rate mortgages. In recent months, despite a reduction in the central bank's lending rate, bond yields have increased due to various economic factors. For instance, market expectations of future inflation or changes in global economic conditions can lead investors to seek higher returns on bonds, resulting in elevated fixed mortgage rates. This means that even as the Bank of Canada aims to stimulate the economy by lowering its rates, external market forces can counteract these efforts, affecting the mortgage landscape. It's also important to consider the role of banks' risk assessments and profit margins in setting fixed mortgage rates. Financial institutions may adjust their rates based on perceived risks in the housing market or the broader economy. If banks anticipate higher risks, they might increase their fixed mortgage rates to ensure profitability and cover potential losses. Some experts, like CIBC's chief economist Avery Schenfeld, suggest that the current economic climate, characterized by uncertainties such as trade tensions and global market fluctuations, is contributing to the disparity between the central bank's rate cuts and fixed mortgage rate trends. Schenfeld notes that while the Bank of Canada's policy decisions aim to support economic growth, the unpredictability of external economic factors exerts a significant influence on the bond market and consequently on fixed mortgage rates. For prospective homebuyers and homeowners looking to refinance, understanding these dynamics is crucial. While variable rates might offer immediate relief following a central bank rate cut, fixed rates require more careful consideration of market conditions and forecasts. As always, it's advisable to consult with financial advisors or mortgage professionals to navigate these complexities and make informed decisions about borrowing. As we wrap up today's episode, let's delve into the potential impact of tariffs on the Bank of Canada's monetary policy. With the recent interest rate cut, there's growing speculation about how the central bank might respond if tariffs are imposed on Canadian goods by the United States. According to Vikram Barhat, writing for Morningstar, the looming threat of tariffs could prompt the Bank of Canada to consider more aggressive rate cuts in the future. The Bank of Canada's recent 25 basis point rate cut, bringing the overnight rate to 3%, reflects its ongoing efforts to stimulate the economy amid various challenges. However, the potential imposition of a 25% tariff on Canadian exports by the U.S. could significantly alter the central bank's approach. Market observers and economists have expressed concern about the economic repercussions of such tariffs, which could necessitate further rate cuts to cushion the Canadian economy. Nick Rees, a senior foreign exchange market analyst at Monex Canada, points out that while lower interest rates could alleviate some pressure on Canadian businesses, the impact of a 25% tariff would require more substantial easing than the Bank of Canada has currently indicated. This sentiment is echoed by Jules Boudreau, a senior economist at Mackenzie Investments, who highlights that while the bank has ended its quantitative tightening program, the inflationary impact of tariffs could complicate future monetary policy decisions. On the other hand, James Orlando, director and senior economist at TD Bank, mentions that the Bank of Canada has acknowledged the uncertainty posed by potential tariffs, but remains optimistic about economic growth forecasts. The central bank projects a 1.8% growth rate for 2025 and 2026, while maintaining a balanced view on inflation risks. However, the threat of tariffs remains a significant consideration for future policy adjustments. Royce Mendes from Desjardins Capital Markets suggests that if a trade war were to ensue, the Bank of Canada might need to implement significant rate cuts, potentially down to 1.50%, to mitigate the economic downturn. This perspective underscores the delicate balance the central bank must maintain in navigating the current economic landscape, particularly with external factors influencing domestic policy decisions. In summary, while the Bank of Canada's latest rate cut aims to support the Canadian economy, the potential introduction of tariffs by the U.S. presents a complex challenge. The central bank's future actions will likely depend on the evolving trade landscape and its impact on growth and inflation. As always, we'll continue to monitor these developments closely and provide you with the latest insights. Thanks for tuning into another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate. Before you go, a quick reminder, Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your homeownership goals. Catch you next time and stay informed with the latest industry insights.